Welcome to Find Your Next Six-Figure Infill Deal. Today is Friday, May 1st, 2026. This week, we are talking about a cottage development on the north end, right in the foothills, a pretty great location. So we'll get into that. And then what I'm starting to do now as well is every week we're going to do like a quick little piece of education about infill development before we get into everything else. So this week, I just want to chat about a couple of changes that we actually made to our weekly deal sheets, and it'll help kind of compare investments both between our deals, but also when people look at these investments versus other investments that they do either in real estate or across asset classes even. So most people that are full-time investors kind of understand these already most of the time, but a lot of times if you invest in real estate, but maybe not full-time, you may not totally grasp the concept of these numbers. I just want to talk about it a little bit here briefly. So the two things that we started doing is on all of our deal sheets, and we'll update the spreadsheet, our infill deal list spreadsheet as well, probably next week. But we're going to start tracking equity multiple, and then also the internal rate of return, or IRR. So basically what your equity multiple is, simplified, is it's just your how many times your money comes back to you. So if you invest $100,000 into an investment and you get $150,000 back, that's a 1.5x equity multiple. So it's just a quick understanding of how much money you're making in return on that money. Now that is separate from time. So let's just make it easy, a 2.0x equity multiple over 7 years. So you're doubling your money in 7 years is, obviously a different deal than a 2.0x equity multiple in 3 years. So that's where the IRR, or the internal rate of return, comes in, where you can actually analyze your compounded rate of return over the time frame. So these two numbers basically kind of play on each other, and then when you have both of these numbers, you can compare your different investments in different assets, whether they're in real estate or even versus your stocks or mutual funds or whatever you're invested in across asset classes. So your IRR is just your internal rate of return on an annual basis, compounded. So, one thing I did like really simply on previous iterations of this is I just divided that time by 2, but that's not actually how rate of return works. So it's compounded typically. So we are going to start adding or putting that IRR in there, which is your if your investment were compounded annually. And then so it's easy to be able to compare these, because if you have let's say your stocks are giving you an 8% IRR versus maybe you have a rental property that gives you a 6% IRR, or a development deal. A lot of times these are 20% plus IRR. So you can get a really good handle on what your investments are doing across asset classes. And you can also then make a decision on if you want to keep those assets. So for example, if you have a stock that's performing at 8% and a mutual fund performing at 9%, maybe you want to divest from that 8% and go into that 9%, or find something that's giving you 10% or 11%. Or I wouldn't ever recommend putting all your eggs in one basket, but if you have real estate deals that are performing better, you can always invest more in real estate deals. So it just gives you an understanding of how to kind of understand each asset class. It's a good idea to keep I think a lot of people already do this, but it's a good idea to keep just kind of a handle on your properties and what their IRR is on an annual basis. Okay, jumping into who I am and kind of what our deal is here and the structure. My name is Zach Matson. I'm a developer and builder here in Boise. I started investing in real estate full-time back in 2016. Before that, I bought my first duplex in 2013. House hacked. I lived in one side, fixed up the other, and rented it. Did that again a little less than 2 years later, and then like 6 months after that, I was in real estate full-time, flipping houses. And then from there, I got into development in 2020. I was just having a hard time scaling as much as I wanted to with the flipping business. And so I saw a huge opportunity at the time in infill development where there wasn't as much competition and it was easier, at least for me, to scale that. And then I was able to even further scale it starting in 2023. And then in 2024, actually the beginning of 2025, so the beginning of last year, I really just saw a ton of opportunity that wasn't getting fully taken advantage of. There was just so many deals out there. I couldn't possibly buy all of them myself unless I raised, tens of millions of dollars or, had a fund or something like that. So instead of doing that, I decided, it's a great opportunity for individual investors to invest in real estate deals that they don't normally ever see or understand. And even less of them can actually implement it. And so I basically decided it was a great way for me and my team to basically help individual investors take advantage of the opportunity that's in infill development. And kind of benefit from the upside. And then it's a win-win because it's bringing in revenue for my company. So it's helping me grow my business and bring in consistent revenue versus, putting out all that money on all the deals all the time and just having to raise money on every deal, which is a full-time job in itself. So saw a lot of opportunity and realized it was a great opportunity for individual investors to jump in, and we created this system. So it took me about 6 months to really put together the system. We launched it in July of last year, and since then have been really just naturally kind of gaining steam. We're gaining steam every week, and the goal is to ultimately sell every single one of these deals of the week, which I think will happen here, within a few months or a year. So getting into our structure and how the infill deal list works. So we have what I call the infill deal list, and it's basically just how I track literally every single infill deal that's available on the market, and a lot of them off market as well. We track Boise, Garden City, and Meridian. There's a few reasons why we just track those three cities, which I'm not going to get into right now, but essentially we have enough opportunity in those three cities that we don't need to track others, and they tend to be the most profitable. So to get access full time to the list, we just have you do a couple different things. So we provide access to both realtors and individual investors. So if you're a realtor, we just have you either attend in person or rewatch our in-person sessions, our parts 1 and 2 on infill development and building. So we just go over kind of like basically how we see opportunities and look at them, and then also our build process. And then part 3 is our infill deal list. We go over how the infill deal list works and what you're seeing on that, and how to look at properties on there. And then we just have you sign basically a non-disclosure agreement, and also an agreement stating that if you're going to use our strategies with your buyers, that you just introduce us early on in the process, and that helps us really get that relationship down, but also make sure everybody's on the same page and understands kind of the system. And then as a bonus for realtors, we also offer free marketing campaigns provided by us that you can co-brand with us. So that's just kind of a bonus. Now, if you're an investor, we also can give you full access to the list as well. We just have a few requirements. The same thing. We have a investor tailored 3-part presentation for infill development, and then our build process and the deal list. And then we also just make sure that you have a signed representative agreement with a sponsoring realtor that's been through the training. So if you don't already have a realtor that you're working with, we can refer you to one of ours that's been through the training, or you can, if you already are working with a realtor, you can still use that realtor. We just have them go through the training as well, and that just ultimately makes sure that everybody's on the same page. These deals don't work the exact same way as a normal house purchase. They're a little bit there's more steps to them, a little bit more complicated. So we just want to make sure everybody's on the same page so we can get these deals done. And then we just have you sign, again, an NDA, and then that a statement basically that or a sheet that says that basically if you're going to use our strategies on the deals that we identify, that you'll use us as the general contractor. That's essentially the main reason why I'm doing this, is to also bring in business for my general contracting firm. So and then kind of how getting into how me and my team makes money. So obviously, as a general contractor, we do the horizontal and vertical. We also put a lot of time and energy and money into setting up this system, and then also going through due diligence during these deals. We have about a 200 point due diligence checklist that we go through on every single one of these deals. So basically, to cover that time and cost and energy that we put into this, we just charge you a consulting fee at purchase, and that's how we essentially recoup our costs and time for that. And then we also do the entitlements, and we just manage the entitlements process. We still use all the professionals, so the engineers and all that fun stuff. And we just charge a management fee for getting the project approved through the different agencies and working with the different professional firms. Okay, getting into how this works, we call this our 6 figures in 36 months or less infill deal offer. So the reason why I created this is because I kind of understood, that investors don't really understand development, and there's not a lot of information out there. There's almost no information out there. I've seen a little bit more and more, but it's still very piecemeal if you can find it, and there's just not a lot out there. So I created this system to basically understanding that investors don't want to lose money on a bad deal, or just not knowing the process, and they're afraid of making a mistake, afraid of projects dragging on too long or contractors cutting corners, but also just not having control or visibility into the project. So the core components of this, number one, is our expert deal underwriting. So we analyze and underwrite every deal on our list. We offer and negotiation support with you and your realtor, so we understand how to get these deals done. It's not like a typical home purchase where you just have a 5-day due diligence and you get your inspection done. A lot of times we need more due diligence time, so we just really kind of work with you and your realtor on how to make offers on how to get them accepted, but also something on terms that work for everybody in order to be fully confident in the deal by the end of it. Then we do the step-by-step due diligence. We provide you with our 200-point due diligence checklist when you have it under contract. You can follow along with that. We do 95% of that due diligence checklist. We just let you follow along with us. There's a few items on there that we have you and your realtor fill out as well, but it's again like 5, maybe 10% of that. And then we have we also, because we're GCs, we can renovate the existing house. So if there's an existing house on the property that needs renovation, I'd say around half the time it needs renovation. So we can do that as well. We just basically use all of our people that we already have in place to do those renovations. And we can do that, if it needs to be turned around on the front end to rent it, or sometimes it can be rented, maybe not for top dollar, but you don't want to renovate it until the very end. We can do it at the very end, so it just depends. Then we do the entitlement management. So again, we're fully vertically integrated. So we run the entitlements in-house. We manage that process, coordinate with all the professionals and all the agencies. And then the last two things is the horizontal and vertical development and construction. So horizontal development or construction is everything that's at ground level and below. So essentially it's all the infrastructure. So you're talking all utilities, sewer, water, power, if we have to put street lights in, sidewalks, curb gutter, streets, parking, that fun stuff. And then we do the vertical. That's everything, all the fun stuff that is the finished product on these homes. So that's starting at foundations all the way up. So we go all the way through certificate of occupancy. If we're going to keep units as rentals at the end, we don't do proper management, but we do have contacts with property managers, both in short-term, mid-term, and long-term space. So pretty much whatever your approach is with it, we can connect you with people if you don't already have those connections. Some of the bonuses we give you, so we give you our ultimate guide, introduction to infill development. If you're on our email list, you should have already received that in your inbox, or you can always reach out. We'll give that to you as well if you haven't gotten that email. And then also we are going to provide you with our due diligence checklist once you have a project under contract. So we'll share that with you and you can follow along. Number 3 is we're going to give you our underwriting worksheet at the end of due diligence. So basically, before you're done with due diligence, we're going to provide you with our 1-page due diligence underwriting worksheet. And what that acts as is your final go or no go, your final investment decision if you're going to pull the trigger or not. Usually before then, we have a really good idea what it's going to look like and if any major red flags came up. But ultimately, that last one-page sheet gives you just really a synopsis of what that investment looks like, and that's also what we base our final guaranteed numbers on. Number 4 is we're going to give you our entitlement process checklist and projected timeline. So once we get through due diligence and start working on the rest of the entitlement process, we're going to give you what that process looks like and those projected timelines for all the approvals. And then after that, once we start construction, horizontal and or vertical, we're going to give you our construction process and inspection checklist for that as well. And then another bonus that we offer is on all of our new construction houses, we actually do a third-party new home inspection report. So we have our project managers, inspect stuff along the way, but we also hire a third-party company to come out and inspect it at key phases. And this just is, essentially, kind of gives you the peace of mind that you're getting a perfect build. Nothing's ever perfect the first time. A lot of times there are, it's built by human hands, so that we have to correct mistakes as they come up. We do that behind the walls. So we do that inspection at framing and rough-ins. So you can see if any mistakes were made, how they were corrected. Then we do it at drywall, interior and exterior finishes. And then we have a final inspection. Sometimes that final inspection is actually 2 separate inspections because we'll have a final kind of correction list, and then we'll come back and make sure that everything was completed. And then essentially that just gives you peace of mind if you're holding on to it, but also, if we're going to resell it, we provide those, you can provide that to the buyer and save your buyer money and gives them more peace of mind. A lot of times it ends up in, quicker sales because you can already provide them with that inspection and they're confident in the deal. So on top of that, sometimes, especially in a competitive market, it allows for, people that are motivated to move quickly. They can look at that versus, have that 5-day due diligence inspection period. Number 7, so we host our monthly progress call. We do that the last Friday of every month, and we just go over the progress that we made on our projects from the previous month. So that's open to everybody, whether you have a deal already or just interested in buying a deal maybe at some point, or if you just want the education, what it looks like behind the scenes on some of the challenges we run into, and how we progress through it. Okay, and then we have 2 parts of our guarantee. Number 1 is our entitlements guarantee. So on today's deal, for example, we have it drawn out as an 8-unit cottage village. So once we get to the end of due diligence, we're going to have a really firm answer on, okay, it can be for sure be 8, or maybe it's only 7, or I know in this scenario it wouldn't be, but let's say it's 9. So when we're at that due diligence end of the due diligence, we back that up with a guarantee. So essentially what that means, if we guarantee 8, but then we only end up getting it entitled for 7, whatever our consulting fee was that we charged you, we actually credit you that towards either your next deal or towards the horizontal development. So we also have skin in the game and back up what we're saying with the money with our money. And then the last one is our underwriting guarantee. So this is our profit guarantee. So basically what it is, we guarantee that if the project doesn't meet at least 100% of the projected profit at final underwriting, we're going to refund you up until it does. Now that's up to a maximum of $50,000 per deal on single or double lot splits, or $20,000 per home up to 10. So up to $200,000 max. So for example, on today's deal where we have, I think it projected at 491, if that's the end, projected profit at the end of due diligence, we're going to back it up with that $491,000 guarantee. If it falls short of that, let's say by 91,000, you only make 400,000. Well, we're going to kick in $91,000 of our profits until you get up to that guaranteed amount. And then, and again, that'll be up to 200,000. If you make more than 491,000, which that's great, it doesn't kick in. You're just our ultimate goal is that we under promise and over deliver. And so we go into all these deals being really conservative, especially once we start diving into the due diligence. And so our ultimate goal is to have these deals end up being 5-10% better than what we actually projected. But it does give you a lot of, it kind of gives you a floor a little bit where you kind of know what you're going to make. And it de-risk it a little bit for you. So there's no such thing as a risk-free investment in anything, but ultimately we're withholding our profits up to a certain extent to make sure that we're the deal's performing the way we said it was going to perform from the beginning. And that's the trust you place in us, and so we back it up. So your role in this as an investor, so you're buying the deal, you hold the full ownership. That's what makes this different than most other, kind of real estate deals of this type. A lot of times, a lot of people invest in like a syndication where they'll invest in it, but they are a limited partner and really have no say in any decision making. They're basically just passive investors. So this is still relatively passive. You're making all the big decisions. We're doing the heavy lifting. We're going to kind of recommend we do things a certain way and design it a certain way, but ultimately you're the final decision maker. And our target on these two is 6 figures in 36 months or less. So some deals are, it's very rare to find a 1-year deal. It's even rare to find a 2-year deal, but we've been kind of seeing them a fair amount now that we've kind of opened our eyes to them. Most subdivisions are usually 3 years. Sometimes if we do it in multiple phases, it can be more than that. Yeah, so getting into the deal of the week here in a second. So let me just pull up my spreadsheet again, and I will share my screen. Okay, the deal this week is in Boise's North End. It's actually at the base of the foothills. What's kind of interesting about this deal, I think it was last summer now, I actually went and saw this house before it ever hit the market. So I know the seller, I've met him. I don't know if it's the same listing agent or not, but before it ever hit the market, I went and talked to him. At the time, I was looking at it as a subdivision, and the price they were asking for it just really didn't make a whole lot of sense. It was okay with profitability, but it didn't make a whole lot of sense. And I'd say really with the asking price now too, it's a little high, but it still makes sense as an investment. Ideally, we could get it priced or buy it for lower. I just don't know how much the seller is willing to budge. But he also might be, I've approached him previously, and I know now he's been trying to sell it for the past year. So he might have a little bit more leeway, but I approached him previously about doing some kind of creative deal where maybe part of it is paid cash and maybe he carries a portion of it, ultimately for the prices asking for it, where it's I think a little bit high for the market. I think he's got to either be willing to come down in price or do some kind of creative deal. So with that said, there's no guarantees on any of that, but ideally we can come in with some kind of offer that makes sense for everybody. So this deal projects out at a little over 491,000 in profit. The total capital invested is a little over 538,000. So this is factoring in. So we know we have a lender that would lend on a deal like this at 40% down. We even have a lender that would probably do 30% down, so it could be a little bit less cash. And then there's, of course, if you got like an investment property loan, sometimes you can do a little bit less than that even. But we'll try to go in with these with conservative numbers. And then this is also paying for entitlements out of pocket. And then also factoring in your carrying costs during the hold period for that purchase as well. So that's your total out of pocket. This deal, because it's a cottage village, without getting too far into the weeds on why it's faster, essentially cottage villages have been codified in the Boise Planning and Zoning, the new code. And so essentially it means quicker timelines on approvals, but then also we don't have to have the plat signed in between where we do horizontal construction and vertical construction. And so that saves you between 3 and 6 months as well. So overall, between those two things, we save usually about a year in development timeline, and then possibly even more. We actually have another one of these deals right now that we're working through approvals. So we'll have a better idea as we go forward. But theoretically, you can do horizontal and vertical at the exact same time. Just logistically, we don't know how well that's going to work. So eventually I'll have in the coming months, I'll have a better idea of if we can make that happen. But right now, we're basically planning for the horizontal to move directly into vertical, not having a big wait period in between, but not necessarily at the exact same time. Then we underwrite this too. If you basically sell the existing house off, so you can sell the existing house separate. This deal on these cottages, essentially this becomes a cottage. You have to do a cottage plat, but then you can sell that property individually and get a lot of your cash back out of the deal. Or it goes to pay down the loan debt. Kind of depending on how that looks like, but that's your final capital in the deal, whether it's at the end and you're going to refinance or just get all your capital back, whatever that looks like. And then this is what it would look like if you kept a unit for cash flow. Essentially, you have about $1,800. I kind of looks like the math kind of got backwards on this a little bit, but your monthly rent on a cottage like this would be at least 1,800. That's for a 2-bedroom, but these are actually 3-bedroom cottages. So I think this is more likely be 2,500. So the way these numbers worked out, you could actually basically keep one of the cottages for free. The existing one you'd sell, you would keep a new one. So you get all your capital back. And then you could essentially have one of those cottages free and clear. And then you could basically rent it and have that income without having to have a mortgage on it. Or you could leverage it more and keep, let's say, 2 or 3 or 4 of them and leverage them more highly, just with less cash flow. So that's always a possibility too. So the nice thing with cottages, it gives you a lot of flexibility versus if you were to just buy an 8-unit apartment complex, for example. The flexibility that doesn't give you is to make that cash flow if with today's interest rates and today what you're paying for it for today. So essentially, if you were to go out and buy an 8-unit apartment complex, you're stuck with that 8 units. On these cottages, it gives you a flexibility because you can sell these cottages individually, and you can recoup or use that to pay down your debt. And then all of a sudden now your leverage is in a lot better position where you can actually cash flow on some of the units, or own one free and clear, depending on what your cash flow situation needs to look like. So there's some options there. So this is the cost breakdown. We feel like even comparing this just with the existing house and comparable sales in the area, we think it's worth about 450,000 as is. So they're asking basically a premium on the land of that difference between the 976 and 450. So a little over 500,000 is what the premium on the actual land is, which is pretty high. For the location, though, it's really not bad, considering it has development potential, especially as a cottage village in the shorter time frame. So essentially, you're paying 75,000 per new lot. The nice thing with cottages is your development costs per lot are lower than a lot of other types of development. Normally you're just bringing in the utilities from the street there, and it's all on one parcel, so you don't have to parcel it off. So typically you have lower cost per unit on that. And then these are the entitlement costs per unit. Then we've already drawn up 3-bedroom, 2-bath floor plans for this other cottage development that we're doing. It'd be 2 stories, 1,000 square feet is the maximum on those. So 3-bedroom, 2-bath, 1,000 square feet. In this location or this part of town, so there's comparables that are actually quite a bit higher than this, at least 10 or 15% higher than this. The little bit of the unknown and why we're going conservatively at 500,000 is because the cottage structure. So the way this works is somebody buys the house, and they have, even in the cottage plat, or the condominium plat is what it is, they don't fully own their lot that the house sits on. So they own the structure, and then it's just like a condominium where you own a portion of the rest of the development. So you have a share in that development, and you even have your own, say, private backyard that's kind of described in that plat. But you don't actually own the yard. So it's a little bit different. So we basically just go in really conservative on the resale. But I think, and we'll know for sure as we sell more of these. But the resale cost on that, I don't think is going to be affected much, especially because there's a lot of benefits with these cottage developments too. So when you buy this, like as a buyer, number one, there's really no such thing as new construction at this price point in the North End. It's not out there. So number one is you have a great price point for new construction. Number two is, somebody is buying a brand new property and they have zero maintenance. So the condominium or the cottage village HOA takes care of all the exterior yard work for a very minimal monthly cost, less than it would cost you to, each individual to go out and pay somebody to mow the lawn once a week. But it's all, the grounds are all taken care of all the time. So people don't have to worry about taking care of their yards. So it's kind of a benefit because a lot of people, people are busy. They don't necessarily want to be taking care of their yards. So it gives an additional benefit like that a lot of people are going to be interested in. They'll pay basically the same price for that, even though they don't necessarily own the specific lot their house is sitting on. So we have a profitability per house of about 86,000. I think realistically these could sell for up to 550,000, possibly even more 2 years from now. Oh, that's too high. Get the right. So if they end up selling for 550, now all of a sudden this project goes from making about a 500,000 to you're making 800,000. So I think very feasibly I could see this scenario playing out. But again, we like to be conservative going in here because there are a little bit unknowns. So we would just want to make sure that we're really confident in the deal. And so we're going to go in conservatively on this sale price, even though we're pretty confident in the other way. And then again, so you can sell the existing house. This would sell for a little bit less because it is a little bit smaller and 2 bedroom, 1 bath. We could even, approach this as, tear it down, rebuild it. Essentially you just basically are spending an extra 200,000 to get an extra 50,000 out of the house. So probably isn't worth it to do that because essentially that's 150,000 difference there that you don't need to lose because you have that existing house. So the existing house profit, this is just factoring in the sales cost of this house, then the carrying cost. This factors in paying the interest for 2 years on that purchase of the house. So basically the carrying costs, it can be rented. There's actually another structure on the property that could probably also be rented separately, but we don't have that factored into this cost because it's a little funky. It's basically a garage, but it does have like a kind of like a, what would you call it? Forget what they call it, but basically a no bedroom apartment. It's like a kind of an open area but it has a bathroom and a kitchen. But you could rent out that separately as well. So theoretically, you could actually probably make a little bit more on this. And then it also has kind of a funny little treehouse on the property too. So I don't know if it's safe enough to rent out, but it could be a cool little Airbnb as well. But we don't have any of that factored out. So you have to factor in the whole project. You lose a little bit of money on the existing house, just with carrying costs, factoring carrying costs and everything. And then your total project to refinance all the debt when it's all said and done. If you want to refinance into long-term debt, that's what that looks like. So we can more easily pencil out if the project makes sense as a rental all in one, if you just refinance into long-term debt. We haven't gone that far with this project. So if somebody's interested, we can. The whole deal, when it's all said and done, if it's the 8 units with the existing one, it's worth about, so let's say about 500,000 per unit. So it's about 4 million. So you're at, what is it, 26 divided by 4 is your loan to value when you refinance. This is assuming you don't take any of your cash out either. So you're at about 65% loan to value. So more than likely, I think that would actually pencil pretty well as a rental. So you could actually theoretically refinance into long-term debt, particularly if you did sell them as short-term rentals. I think it could actually pencil really nicely as a rental complex to keep it as a rental property. Okay, any questions on this one before I jump into, actually, let me show you. This is the photos of the property itself. So it is kind of backed up to the hillside, and so I've actually seen this. The rest of the green areas are relatively flat, so they'd be pretty easy to develop. And that I didn't. None of the site plan digs into the hillside, so I have parking back here, and then I'd have a couple cottages here, and then more on the other side. Um, so as the overhead here, this is the existing structure. So I have on my site plan parking here, a little bit of parking here, and then cottages here and along this property line here. This right now is a dirt driveway. Um, I would have, we would pave this. We'd have to bring in some utilities up here, and then I would actually probably have a separate, because there's a shared driveway with the neighbor here. So there'd be a little bit of figuring out, how to set that up properly with the neighbor and everything. So there's a little bit of due diligence that would have to be done during this whole process with approvals and everything. But there is right across the street, you have ball fields, and then also right here is a golf course. And then also right here, all of these foothills, there's trails all over these foothills. So directly across the street, there's actually direct access to the foothills trails, which leads to the Ridge to Rivers trail system, which is over 200 miles. Right in this area over here is on the other side of the ridge is the uh, Highland Hollow or Highland, whatever it's called, but there's several miles, and it's a really popular hiking trail just on the other side over here. And then there's some unnamed trails further down the road here. So great location, like I said, right across the street from a school and ball fields and the golf course, and also hiking trails. So right now there's a house that's pending that's 1,000 square feet that's older, but it looks nice. That's pending, I think, at 560, I want to say. Um, so again, I think there's comparables that could show that these could very well, the cottages that we put in could very well sell for over 500. And then this is just the overhead. This is actually a little cleaner overhead, kind of shows you the existing house kind of right in the middle. So my site plan, I have 5 houses here, 2 houses here, parking back here. This structure might end up having to get taken down. I don't think it's permitted properly. And it's also doesn't meet the setback requirements. So the city might require that this be torn down, probably would, unless we can prove that that predates any kind of zoning, which I doubt that's the case. So more than likely, this would get taken down once we start to develop it, which just means actually a little bit better parking structure than what I had. And this is the one-page deal sheet that I send out. So if you guys get my emails, this looks familiar. If you're just watching this video and you don't get the emails, this is the new structure. So we're going to do kind of the breakdown, really quick breakdown right here. What your total cash investment is required, what you get back. This isn't the profit, this is just your total return. So it's your investment plus the profit, and then your equity multiple, your IRR, and then the timeline. And then more of the investment summary below here, a quick overview of the play, and then what the capital stack looks like. Then we have your neighborhood, the size of the project, how it's zoned. And then we have our highest and best use, and then also some details on the exit strategy, and then why this deal is a good deal. So that's kind of the new structure that we're going to set up. I think it's a little bit quicker and easier for people to look at and understand the full picture. And then this is kind of what the overhead site plan looks like. So that's that existing house. This is where the parking would be. And then we have the 5 units here and the 2 units along the other side of the house here. So these all kind of center to the house. And then this is the style of house I would kind of go for with that property. Would fit in really well in that area. I'd call it kind of a modern craftsman look, I would say. Okay. Any questions before I move on to any other deals? I'm going to briefly go into the deal from last week. We covered this more in depth last week, so I'm not going to get into the weeds too much on this one, because if you want to More details on this deal, you can go and watch the replay from last week where we go into each of these deals of the week, usually about 20 to 30 minutes. We cover the deal more in depth. So if you want to get the more in-depth review of this one, you can rewatch it from last week on our YouTube channel. But this is another cottage deal. This is in West Boise. And so there's an existing house that's 2,100 square feet. The nice thing with these, also with them being an existing house on the property, is you can rent these out. Both of these properties, the house is in rentable condition. The house on this property, I didn't show pictures, but it is in rentable condition. It's maybe a little bit dated, but it's pretty nice. Then same thing, I think, with this Sparrow Street, is it's in good rentable condition, maybe just slightly dated, but you could probably just resell it as is, or not updated, because I don't think there's a whole lot of margin in updating it and getting your return on investment by updating it. This deal anyway. They are asking a little bit of a premium on the land. So if this house wasn't sitting on land at all, I think it would sell for $575. So this is what you're paying for the premium on the land. And then again, you have your entitlements and development costs. On this one, your per lot or per unit development costs are a little bit lower, just because of the infrastructure and the distance from the road. But then same thing on here. And so the build costs are about the same, but what we have on this part of town, this resale cost is still good. I think it'd be probably, again, we're pretty conservative on this, but I think it'd be pushing close to 400. But again, you just have a different margin there because it's a different area of town. So even though you're paying less on the land per unit, you're basically paying the same build costs. But your resale price, you have a big gap there, and that's why this profit per unit is less. But you also have more units. You have 10 versus 7 on the other one. So still a good deal. Takes a little bit less cash. And again, because this property is a little bit closer to what it's valued at, I still think, you could more than likely, especially if it sits on the market for a few weeks, more than likely you can get a little bit lower price on this, because they are asking a decent premium on the land itself, but still has a ton of opportunity. So big opportunity, less capital again. And then we have another cottage deal as well. And this one still hasn't sold. It kind of blows my mind that it hasn't. We have multiple people interested, but nobody's pulled the trigger yet. So this is another cottage. This is actually 11 cottages, again, West Boise. There's an existing house that's a little over 3,000 square feet. The nice thing with these new cottages, again, you can resell the existing house. There's a few steps to get there, but you're retaining this value. Like this one is actually selling for about what the existing house is worth. In fact, we know that it'll have to be remodeled to resell it, but so we have a remodel budget of 130,000. It could be more or less than that. We haven't, we'll fully analyze that once we actually have it under contract. But then you have your the existing house. We feel like it'll sell at that size, fixed up. It would sell for 725. And so that's where you get, even though you have some holding costs and sales costs there, you essentially essentially break even on the existing house, but that means you're in the land for essentially free on this deal. So again, on this deal, you get about the same price on these. We put a little bit more on the resale because on this property, each unit would have a little bit bigger yard than some of these other ones, and we could put amenities in there as well. So we have a little bit more room. So you have a little bit more profitability per unit on this one, just because you're in the land essentially for free on this one versus the other units, you're paying a premium on the land. So ultimately, that's why this one's even more profitable. So that's 3 cottage villages. And actually, we have a 4th one. This was another deal that we had a deal a week. So this is basically, I think, maybe all but 1 week, basically since last month, the middle of last month. So I think the 5 or 6 weeks in a row, aside from maybe one, we've had these cottage deals. This is another one. We could do a cottage development. This is a little multi-step because it's actually 4 different properties. So again, I covered this on April 3rd. So I'm not going to dive in too deep with that. And it does take a little bit more cash. But the benefit of this one is actually already has a fourplex on one of the properties. There's three other properties that each have a single family home on. So you could buy this property. It's probably about overall, this is probably about $200,000 overpriced. So ideally, you could get it close to what it's actually valued at, or get some kind of seller terms in there to reduce your capital expense required. But it already has income producing properties on all four of those. So you could actually kind of take some capital out of pocket, but you're going to be able to pay your the mortgage payments on it with the existing rents, depending on what that looks like. So that's another good one. So basically four of them that are still on the market. This one actually went pending that same weekend, but then it actually just came back on the market, I think yesterday or the day before. And then we have one I wanted to point out on vacant land. So the difference between like subdivisions and vacant land, subdivisions already have an existing house on them. So the nice thing with that is you can leverage that a little bit easier on getting a loan. Vacant land, it's a little bit harder to get loans on. You have to usually use a little bit more leverage, or just buy them cash. But what I wanted to point out was that we have a deal right here. And again, I mentioned this last week, and so they just reduced the price on this. This is on the market for $395, but we've actually have an LOI out that they've already agreed to do a cash purchase of $350 on this. We actually have an investor lined up for this, but there's another property next door to this that we're trying to get an agreement. So I'm not going to cover the details on that one specifically, but we're trying to get an agreement with the seller on that one to sell us that property as well. And so we can do an assemblage of three properties and essentially turn it into a 25 unit development. There's a fourth parcel that can be a part of it now or later, that it doesn't really necessarily affect the three, but that could add another six. So essentially we could turn this into an assemblage that ends up being better for everybody. So this is the profitability on this project or on this parcel. And then we're just trying to get the other parcel that's attached to this under contract as well, or an agreement with the seller. So we're working on that. That's the only thing I wanted to point out there. So if anybody's interested in another, part of a larger development, it's actually probably going to look pretty similar to what this looks like, because it's the same amount of units. It's a little bit smaller parcel, but I know he wants a little bit more money for it, because he thinks he has leverage that way. But the profitability looks probably pretty close to what this will look like. So. All right, let's see if there's anything else this week. Oh yeah, there's another deal that came on the market. This is a double lot split. So this house, we could actually split two houses off of. You could actually make 221. Depending on what this is appraises for, I think where they're asking a little bit much for this house is probably close to a 669 value. So, if it appraises for 739, great. But you can get a traditional mortgage on this. So you could theoretically even get this lower, particularly if you were going to live in it. Like if you did an owner occupied, you could essentially get your capital down below 200,000. So just depending on what your situation is, this could be a lot less capital. And then particularly too, this is factoring in paying out of pocket for the entitlements and also the little bit of development. So a lot of these infill lots, they need a little bit of development costs in here. So what that looks like, a lot of times it's adding sidewalks, and then also like bringing a sewer line to each lot from the street and adding power, upgrading the power. So that's what that looks like. So that's what this number is, and that's factoring in doing that out of pocket. There is likely a way to finance this as well. So theoretically, you could probably do this less money out of pocket, less this 60,000 out of pocket as well. So if somebody's trying to max leverage, and if they did an owner occupied, you could probably get this down to, so if we did 5% down, so if you owner occupied this and then you were able to get a loan, even if you did like a private money loan and you took out this expense, which is the development costs, you could theoretically get into this house for around 120,000 and then split it off and make 220,000. So a few more hoops to jump through to get there. But depending on somebody's situation, we can analyze the situation for each individual's, what their financial situation is and what they plan to do with it. So we have a couple of people that are looking for owner occupied properties. So that's why I bring this up, is you could do this theoretically for less out of pocket. If you're just approaching as an investor, you have to put a little bit more money down. Of course, when you buy a rental property and you're not going to owner occupy it, a lot of times you have to come up with that, between 15 and 25% down. So we analyze that here, and then doing the loan once you have to actually have a final plat. The benefit to that too, so once you do this out of pocket, you can actually sell that existing house now, get some of your capital back. This is the capital you have into those 2 additional lots now. And then you can build and sell those, and you still make good money. So you're making about 6 figures, a little over 6 figures on each house. You're making a 150 on each house, but then you have essentially that existing house. We're assuming, again, it's not worth the 739. If it could sell for the exact same price that they're asking, then it's essentially break even. We're just not going to go in with that assumption. And again, if you could get it for lower, that's the same thing. The profitability actually goes up. So basically with this structure, we can kind of analyze it differently depending on the kind of money you want to put down or what your personal situation is, and then also how the negotiations go when you go to buy these. Okay, I think that's all the deals I was going to cover for this week. I'm going to stop my share here and stop the recording. If you guys have any deals that you see, if you're watching this on YouTube or somewhere else, you can reach out to me directly. We can discuss your situation and cover any additional details that you need, and see if we can get one of these deals done.